Somewhere in Texas, there's a building the size of several football fields, filled with tens of thousands, sometimes more than 100,000, of the most advanced computer chips in the world. Each one can cost tens of thousands of dollars. Put them together, and you are looking at billions of dollars of computing equipment concentrated inside a single building. And on their own, those chips are almost useless because training a modern AI model is not one chip sitting there doing all the work. The job is split across thousands, sometimes tens of thousands, of processors. One chip calculates one piece, another chip calculates another, and constantly, they have to tell each other what they found, again and then again, thousands of times every second. If those conversations slow down, the processors start waiting, and suddenly you have billions of dollars computing equipment spending part of its time doing nothing. So one of the hardest problems inside a modern AI data center is not simply doing the computation, it's moving the information. For most of computing history, we moved that information through copper. Copper is cheap, it's reliable, and engineers know extremely well how to use it. But as the amount of data rises and connections get faster, copper runs into a physical problem. Electrical signals weaken and distort as they travel. And the faster you push them, the more difficult and more power hungry it becomes to move them over longer distance. Some electrical connections become practical only over distances measured in meters, not kilometers. So when the processor needs to communicate further across a large AI cluster, the industry increasingly does something completely different. It stops moving the information as electricity and starts moving it as light. The electrical signal leaves the processor. A tiny semiconductor laser creates light. Another device writes the information onto that light. The light travels through a strand of glass, thinner than human hair. And at the other end, another semiconductor converts it back into electricity. This happens billions of times every second, across an enormous web of connections inside modern data centers. And as AI systems get larger, the amount of light they need keeps growing, which creates a very simple question. Somebody has to make the light. This is the full coherent map. By the end of the video, you understand what every major part means, where coherent sits in the optical stack, where its advantage may be, and what actually matters for the business. If you are interested in getting my videos in advance, please consider joining the membership. Research Tier member can also download infographics from my videos, and this is for educational purposes, not financial advice. Start with one piece of data moving from one processor to another. Inside the processor, and across the circuit board around it, information moves as electrical signals. That is still the natural language of computing. For short distances, it works extremely well. The trouble begins when you try to move more and more data further away. At very high frequencies, an electrical signal does not travel down a conductor as cleanly as you might imagine. It loses energy. It distorts. Different parts of the signal can arrive at slightly different times. Engineers can compensate for a lot of this with better materials, equalization, signal processing, and more power. But every fix has a cost. Eventually, instead of spending more electricity trying to preserve an electrical signal, it becomes more efficient to turn the data into light. So how do you do that? First, you need a source of very pure, very controlled light. That is the laser. In this video, when I say laser, do not picture a giant beam cutting through steel. Picture a semiconductor device roughly the size of a grain of sand, sitting inside a module that fits in your hand. Then you need to put information onto that light. Think of Morse code. You can send information by changing a signal, light, no light, light again, in a pattern the receiver understands. At lower speeds, one way to do that is to change the laser itself. But at very high speeds, constantly turning the laser up and down becomes harder to control cleanly. So a common design keeps the laser producing stable light and puts an extremely fast device beside it that changes the light instead, almost like a microscopic shutter. That device is called a modulator. The idea is still a little like Morse code. The difference is that instead of a person typing out dots and dashes, this device is encoding billions of bits every second. One important version combines a laser and that modulator into a device called an electro absorption modulated laser, or EML. That is one common high-speed design, not the only one. Other links use directly modulated lasers, vertical cavity lasers, or silicon photonic architectures with a separate light source. The job is still the same. Create clean light, put data onto it, and do it with as little power as possible. Next, the light needs a road. That road is optical fiber. a strand of extremely pure glass that guide light with very low loss. At the far end, you need the reverse process. A photodetector absorbs the incoming light and turns it back into electrical signal that the receiving electronics can understand. Package the transmitting and receiving function together, add the electronics and connectors, and you get an optical transceiver. That is the small box you see plugged into the network switch. It looks simple. Inside it is a miniature optical system doing conversions at extraordinary speed. So before we go any further, let's put all of these pieces together. The processor starts with the electrical signal. The transceiver takes that signal and converts it into light. Inside the transceiver, a laser provides the light. A modulator puts the data onto it, and the optical fiber carries the light to the other side. At the receiving end, a photodetector turns the light back into electrical signal, and the next processor can understand it. So at the highest level, the whole system is doing something very simple. Electricity becomes light, light carries information, and then light becomes electricity again. The engineer required to do that billions of times per second is anything but simple. Large AI clusters need enormous amount of these links, and almost every physical object we just walked through, the laser, the modulator, the detector, the packaging, the finished module, is built by one company that most people have never heard of. It's called Coherent. Which brings us to the reason we are making this video now. On August 12, 2026, Coherent reported the best quarter in its 55-year history. Revenue passed $2 billion in a single quarter for the first time ever. The data center business grew almost 60% in a year. Margins improved. Guidance for the year ahead came in above what Wall Street expected. The chief executive described customer demand as exceptional. The stock still fell. Not because anyone thought the numbers were bad. They were remarkable. It fell for a much more interesting reason. And by the end of the video, you understand that reason well enough to have your own opinion about it. To get there, we need 3 questions answered in order. Why is this light so hard to make? What does Coherent actually own? And does owning it turn into money? So let's go one layer deeper. Behind the module, behind the laser, all the way down to the material the laser is built on. The company we call Coherent today did not start as an AI company. It did not even start as a laser company in the form most people would recognize. It started in 1971 under the name 26. The name came from the periodic table. The founders were working with compound materials formed from elements in different groups of the table, materials with optical and electrical properties that ordinary silicon does not have. For decades, 26 accumulated specialized capabilities, engineered crystals, optical coatings, compound semiconductors, lasers, and components used across communications and industry. Then came a deal that turned out to matter enormously for the AI story. In 2019, 26 bought Finisar. Finisar was already one of the largest fiber optic communications companies in the world. It built transceivers, but more importantly, it has spent years developing the semiconductor lasers and optical components inside those transceivers. That gave 26 something much deeper than a finished product line. It gave the company manufacturing experience at a layer that would later become one of the tightest constraints in AI networking. Then a few years later, 26 made an even larger bet. It bought Coherent, a major industrial and scientific laser company, for roughly $6.5 billion. The deal closed in July 2022, after a bidding war, and 26 eventually adopted the Coherent name. The timing looks terrible. Telecom spending weakened. Industrial demand softened. The acquired laser businesses entered a cyclical downturn. Revenue fell in fiscal 2024. The combined company reported losses, and the debt used to fund acquisition became a very real burden. For a while, the story was not AI growth. It was integration, leverage, weak end markets, and whether management had overpaid. Then the board brought in Jim Anderson as chief executive in 2024. Anderson came from the semiconductor industry, including Lattice, AMD, Intel, and Broadcom. His background was much closer to high-volume semiconductor economics than to the traditional materials culture of 26. There's an important correction to the way this story is sometimes told. The 2022 Coherent acquisition did not create the AI optic business. The communications asset that later became critical to AI came largely from Finisar, acquired 3 years earlier. That makes the history more interesting. The company spent billions buying one business, struggled with the consequences, and then the part of the portfolio that changed its trajectory came from an earlier deal that made before the current AI boom even existed. They had already built the right capability. The market around it changed. In other videos, we talk about copper, Copper is the material that carries the electrical signal from one place to another. But now we need to go one step deeper. Once you decide to stop sending that information as electricity and start sending it as light, you need something that can actually produce light. And that brings us to silicon. Silicon is astonishingly good at computation. We have spent decades learning how to put billions of transistors onto it cheaply and reliably. But silicon has one important weakness. It's not naturally good at emitting light. The reason comes down to the way electrons behave inside the material. When an excited electron in silicon loses energy, that energy does not efficiently come out as a photon. In plain English, silicon would much rather turn that energy into heat than into useful light. That doesn't mean silicon is useless for optics. Far from it. We can use silicon to guide light, split light, route it, and modulate it. But if you want an efficient high-speed laser at the wavelengths used in fiber optic communications, you generally need a different kind of semiconductor. And one of the most important is indium phosphide. Indium phosphide is a compound semiconductor made from indium and phosphorus. It can emit light efficiently at wavelengths that travel very well through optical fiber. That makes it extremely useful for high-speed communications lasers. And it's much harder to manufacture than silicon. You start with a specialized substrate. Then you grow extremely precise semiconductor layers on top of it. Those layers can be only nanometers thick, and tiny variations can change how the laser behaves. Then you pattern the wafer, build the laser structures, cut the wafer into individual dies, package them, test them, and throw away the ones that do not meet specification. The last point matters. In semiconductor manufacturing, yield is everything. If 90 out of 100 devices work, you have a one cost structure. If only 60 work, the 60 good devices have to absorb the cost of the 40 failures. This is where coherent depth matters. Coherent does not own indium phosphide as a material, and it does not control the world's substrate supply. It buys substrate from specialist suppliers. The advantage is the manufacturing system built around it. Decades of compound semiconductor expertise, wafer fabrication, laser design, detectors, optical components, packaging, module integration, and customer qualification. Those capabilities are difficult to reproduce quickly because every laser feeds the next. A better wafer process improves the laser. Better laser performance changes the package. Better packaging improves the yield. Higher yield lowers cost. Lower cost lets you compete more aggressively in the module. Now look at the size of the wafer. Historically, a lot of indium phosphide production used 3-inch wafers. Coherent has been moving production onto 6-inch wafers. Doubling the diameter gives you roughly 4 times the area. In simple terms, one trip through the factory can produce far more laser dies. Coherent says the 6-inch platform can deliver about 4 times the device capacity and reduce die cost by more than 60%. That gives Coherent a structural cost lever. At the same time, company-wide gross margins have moved sharply higher. That improvement is now coming from one thing alone. Product mix has improved. Factories are fuller. Pricing has been strong in constrained products. The company has been restructuring, and manufacturing improvements, including a 6-inch transition, should help lower unit cost. The important point is not that one bigger wafer explains every basis point of margin expansion. It is that Coherent has a credible way to make the same optical function at lower cost over time, while demand for that function is rising. That is a much stronger position than simply selling into a hot market. So the crystal is where the story starts. The moat, if there's one, is not the material itself. It is everything Coherent has learned to build around it. In March 2026, NVIDIA made the importance of this optical layer very difficult to ignore. It invested $2 billion in Coherent, and on the same day, it invested another $2 billion in Lumentum, Coherent's closest Western rival in several of these optical components. That detail matters. NVIDIA did not pick one winner. It secured relationships with both. The message was that advanced optical capacity had become strategically important enough for NVIDIA to put billions of dollars behind the supply chain. As AI clusters scale, total network traffic rises enormously. More traffic requires more bandwidth. More bandwidth requires more optical ports. And more optical ports require more lasers, modulators, detectors, packaging, and manufacturing capacity. NVIDIA does not want a shortage of a relatively small optical component to become the reason it cannot ship an extraordinarily expensive AI system. There's another side to this relationship. Hyperscalers and AI system companies are enormous buyers. They can provide volume, visibility, and validation. They also have bargaining power. In a shortage, a concentrated customer relationship can feel like a partnership. But when supply catch up, The same customer has every incentive to qualify a second source and push on price. And NVIDIA's second $2 billion check tells us exactly why the competitive map matters. There's another company sitting at the same critical layer. Before we compare Coherent with its competitors, let's zoom back out. Because Coherent is not just an AI optics company, the easiest way to understand the portfolio is not by the accounting segment, it's by asking what the products physically do. The first group moves information. This is the business we have spent most of the video on. Lasers, modulators, detectors, transceivers, and other optical components used in data centers and communication networks. Some of those links are only a few meters. Others run between buildings, across cities, between countries, or under oceans. At the longest distance, the system uses a more sophisticated form of optical transmission that preserves information in the phase and amplitude of the light, not just whether the light is present. That technique is called coherent optics. And yes, coherent optics and the company Coherent sharing a name is confusing. They are not the same thing. The second group manipulates materials. These are industrial lasers used to cut, weld, mark, drill, and process materials. They show up in factories, semiconductor manufacturing, electronics production, displays, and scientific equipment. This is where a lot of legacy Coherent acquisition sits. It's a real business, but it has been much more cyclical and much softer than the AI networking recently. The third group supplies enabling materials. Coherent has long-standing expertise in engineered materials and compound semiconductors, including areas such as silicon carbide and specialized optical materials. Some of these businesses have been restructured or partially sold as management had tried to simplify the company and strengthen the balance sheet. And then there's a newer group of products that could matter more over time. Optical circuit switches can route optical paths without converting everything back into electricity. Co-packaged optics components move optical functions closer to the main networking chip. Thermal management products help remove heat from increasingly power-dense AI hardware. These are not yet the core of the financial story, but show where Coherent is trying to go as AI infrastructure changes. Now look at the revenue mix. In fiscal 2026, total revenue was about $7.1 billion. Data centers and communications represented roughly 3/4 of that total, and they accounted for essentially all of the growth. Industrial remains soft. That distinction matters. Coherent is diversified enough that a downturn in one market does not erase the whole company. But the reason the company is being revalued today is not the industrial lasers or broad portfolio. It is AI networking. And now we can finally talk about computation. And the first thing to understand is that Coherent is not the biggest company at every layer of the optical stack. In finished data center transceivers, Chinese suppliers such as InnoLight and Optolink are major players, and some market share estimates put InnoLink ahead of Coherent. So if you look only at the finished module, the thing physically plugged into the switch, Coherent does not obviously look dominant. Now open the module. Inside are laser, modulator, detector, signal processing chip, packaging, fiber interface, and other components. The competitive map changed immediately. The number of companies that can make advanced high-speed laser component at serious volume and acceptable yield is much smaller than the number of companies that can assemble a finished transceiver. That is where Coherent becomes much harder to avoid, which produced one of the strangest facts in this industry. Several of the companies that compete with Coherent in finished modules are also its customers for the component inside them. There are a few ways to compete in this industry. One approach is to focus on optical components. Lumentum is the closest comparison here. It has deep laser and photonics expertise, strong exposure to the same AI build-out, and a more focused portfolio than Coherent. Another approach is to win at the finished module. Companies like InnoLight and Optolink have enormous manufacturing scale and strong positions in complete transceivers. A third approach is to specialize in manufacturing. Fabrinet is a good example. It is an exceptionally efficient contract manufacturer for optical and electronic products. It can build at scale for other companies without needing to own every underlying component technology. And then there's Coherent's approach. Own much of the stack, materials expertise, wafer fabrication, lasers, components, packaging, and modules. That gives Coherent a very different set of economics. During a shortage, vertical integration is powerful. If lasers are scarce and you make your own, you do not have to wait behind someone else's allocation. You can prioritize the product that matters most. You can capture value at multiple stages, and the engineering team can optimize the laser, package, and module altogether. But vertical integration also has a second phase. When demand weakens, you still own the factories, The equipment still depreciates. The clean rooms still need people. The fixed costs remain even if utilization falls. So vertical integration is not automatically a moat. It is leverage. It amplifies the environment in both directions. That is why the coherent Lumentum comparison is so useful. Both companies benefit from the same rise in optical intensity inside AI systems. Both are important suppliers of advanced laser technology. Both received $2 billion from NVIDIA on the same day. But the businesses are not identical. Lumentum is more focused. It gives investors cleaner exposure to optical components and has been very strong in the newest high-speed laser generations. Coherent is broader and more vertically integrated. It owns more manufacturing layers, has a larger communications module business, and carries diversification from telecom, industrial, and materials. One model can be easier to run. The other can capture more of the stack. Which one creates better economics depends on the cycle, the technology transition, and execution. There are also places where coherent advantage is much weaker. Commodity module assembly is one. Chinese competitors are very good at building transceivers cheaply and at scale. The digital signal processor is another. That is a high-speed electronic chip that cleans up and shapes the electrical signal. Coherent does not own that layer. Broadcom and Marvell are major suppliers there. So when Coherent sells the complete module, part of the value inside that module belongs to someone else. And that is why the right question is not, does Coherent dominate optics? It does not. The better question is, which parts of the optical stack are difficult to substitute, and how much of those parts does Coherent control? The next challenge is that the optical architecture itself keeps changing. Network links have moved from 100 gigabits to 200, 400, 800, and now 1.6 terabits. 3.2 terabits is already on the roadmap. Each generation carries more data through a connection. Early in a new generation, the optics are usually more expensive and technically difficult. Over time, computation and manufacturing improvements drive the cost per bit down. At the same time, the electrical problem we started with is moving closer and closer to the networking chip itself. Today, a typical pluggable transceiver sits at the front of a network switch. The electrical signal leaves the switch chip, travels across the circuit board, reaches the module, and only then becomes light. As speeds rise, even that short electrical chip becomes expensive in power and signal integrity. So the industry is increasingly exploring an obvious solution: move the optical engine much closer to the switch chip. That is the idea behind co-packaged optics. For Coherent, that transition is both a threat and an opportunity. The threat is easy to see. If more optical functions move onto the switch package, some of the value in today's pluggable module can disappear, but the light source does not disappear. The system still needs lasers, photonic components, packaging, fiber attachment, and optical engines. In some architectures, a centralized high-power laser source becomes even more important. So Coherent can lose value at one layer while gaining it at another. That pattern is worth remembering because it's one of the most important things about this company. A technology transition is not automatically good or bad. For Coherent, you have to ask where the value moves. The same is true as 1.6 terabit products ramp and later generations arrive. Management expects newer products to carry attractive margins. The real test is whether Coherent's dollar content per connection rises, whether multiple customers qualify the products, and whether the manufacturing advantage survives once competitors catch up. The question is not simply whether co-packaged optics become important. The question is how quickly it arrives, where it is used first, and which part of the new architecture Coherent get paid to supply. And there's another force shaping the industry. It pushed Coherent in two directions at once. China is both part of the upstream supply chain and home to some of the Coherent toughest downstream competitors. Start upstream. Indium is not produced at enormous scale, and China accounts for a large share of global refined production. China has also placed export control on certain indium-related materials, including indium phosphide substrates. For a company whose strongest optical products depend on this material system, that creates an obvious supply chain risk. That helps explain why Coherent is expanding indium phosphide manufacturing capacity in Sherman, Texas, with support tied to the US CHIPS program. The point is not that Texas fab makes the company independent of every foreign input. The point is to increase domestic manufacturing capacity, reduce single points of failure, and make the optical supply chain more resilient. Now look downstream. In August 2026, Reuters reported that the Federal Communications Commission was drafting restrictions that could block new models of Chinese optical transceivers from entering the United States on national security grounds. If a rule like that is finalized, US and allied suppliers could benefit. But this is exactly the kind of headline that needs restraint. The proposal was still a draft. It could change. It could be delayed. And direct Chinese transceiver export into the United States are only one part of the much larger global supply chain. Policy can shift the competitive landscape. It does not automatically hand Coherent revenue. So China cuts both ways. The same country that created upstream material risk also produced some of the strongest low-cost competitors in finished optics. And the same geopolitical tension that creates supply chain risk could also make non-Chinese suppliers more strategically valuable. That tension is not going away. Now we can ask the question that ultimately matters for shareholders. Does any of this technical advantage turn into a better business? There are 4 numbers that I care about. First, revenue. Fiscal 2026 revenue was about $7.12 billion. The fourth quarter alone reached roughly $2.05 billion. The first quarter in company history about $2 billion. The important part was the mix. Data center and communications grew sharply. Data center alone grew around 66% year over year in the quarter. So the company is not simply growing evenly. The center of gravity is moving toward AI and communications. Second, margins. Non-GAAP gross margin reached 40.2% in the fourth quarter and 39.4% for the full year, up roughly 660 basis points over 2 years. That matters because revenue growth without margin improvement can simply mean you are selling more low-value hardware. Here, the mix has moved toward higher-value products. Factories are operating at high utilization. Constrained products have supported pricing, and manufacturing changes such as a 6-inch indium phosphide transition should improve unit economics over time. The exact contribution from each factor is difficult to isolate, but the overall direction is clear. The company is keeping more gross profit from each dollar of sales than it was before. Third, the balance sheet. The debt problem created by the 2022 acquisition has become much more manageable. Net leverage has fallen from about 3 times earnings at the time of acquisition to roughly 0.7. A company with manageable leverage can think about capacity, technology, and market share. And fourth, cash. Coherent reported roughly $79 million of operating cash flow for the year, while capital spending was around $1.1 billion. If you use the simple definition of free cash flow as operating cash flow minus capital expenditure, that's roughly negative $1 billion. But at the same time, inventory grew to about $2.6 billion. It means the company is spending aggressively and tying up cash in working capital, while prepared for demand that has not yet fully turned into shipments. Factories need equipment before they produce revenue. Inventory has to be built before it can be delivered. Customers place orders long before Coherent collects the cash. If those orders convert, the cash flow picture can improve quickly. If demand cools first, the same factories and inventory become a burden. That is the financial version of the vertical integration trade-off we discussed earlier. When the market is tight, owning capacity is an advantage. When the market is loose, you still own the capacity. After the most recent results, Coherent traded at roughly 79 times its reported earnings for the year just finished, and somewhere around 40 times what analysts expected to earn over the next 12 months. For context, the 10-year average for this company is closer to 44 times earnings, and the broader technology sector sit around 34. So the business is improving, and the price already reflects a great deal of improvement. Whether those two facts can coexist comfortably is the argument we'll get to shortly. Now let's look at the bull and bear cases. The bull case rests on 6 things. The first is that the demand visibility is real. Coherent has reported an unusually strong order environment, with orders extending years into the future, and long-term agreements that include minimum volumes and pricing terms. That is not the same as guaranteed revenue. Orders can change, customers can change plan, and industries can overbuild, but it gives Coherent much more visibility than a normal semiconductor cycle. Second, Coherent stays difficult to avoid at the component layer. The bull case does not require Coherent to become the largest transceiver company in the world. It requires the company to remain important in the lasers, detectors, components, and the manufacturing processes that other companies themselves depend on. Third, each new generation carries more value. 1.6 terabit links are more technically demanding than 800 gigabit links. Co-packaged optics change the architecture again. Optical switching and thermal management add new products around the same AI infrastructure build-out. If Coherent keeps winning qualifications as the architecture change, the company can grow even if some older products eventually commoditize. Fourth, the manufacturing cost curve keeps improving. The 6-inch indium phosphide transition is important because it is not a marketing story about demand. It is a manufacturing story about cost. If the company can keep improving yield and get more devices from every wafer, that advantage can survive even after today's shortage eases. Fifth, the balance sheet stays strong enough to fund expansion. The company is spending heavily because management believes the orders are real. If leverage remains controlled, Coherent can build capacity without recreating the balance sheet problem that followed the 2022 acquisition. And 6, the spending has to turn into cash. This is the most important one. Revenue can grow, EBITDA can grow, earnings per share can grow, but eventually, the factories and inventory need to generate free cash flow. If that happens while gross margin remains strong, the bull case becomes much more convincing. Management has said it expects quarterly revenue to move about $3 billion before the end of fiscal 2027. But if the company gets anywhere close while preserving margins and improving cash flow, the financial model changes very quickly. The simplest version of the bull case is this. Coherent does not need to dominate every optical module. It needs to remain difficult to avoid in the components underneath them. The bear case starts with an uncomfortable fact about optics. This industry has a long history of turning difficult technology into commodity hardware. A new generation launches, supply is tight, margins look wonderful. The more capacity comes online, competitors qualify, price per bit falls, and the economics normalize. There's no law of physics that says advanced lasers remain scarce forever. The second risk is customer concentration. Large customers are wonderful when they need every unit you can produce. They are less wonderful when supply loosens. A hyperscaler or AI system company has enormous purchasing power, and it has every incentive to qualify multiple suppliers so that no single vendor controls price. Third is the capacity bet. Coherent is spending heavily and carrying a large amount of inventory because management expects demand to keep rising. If that demand is right, the capacity is valuable. If the industry is collectively building too much at the same time, utilization drops, and margins can reverse faster than investors expect. Fourth, the architecture can move value away from the products Coherent sells today. Co-packaged optics is the clearest example. Coherent can participate in the new architecture, but participation does not guarantee the same revenue or margin that the old pluggable module provided. Fifth, competition can move deeper into the stack. Chinese suppliers already have enormous scale in finished transceivers. Over time, they will try to internalize more components. Broadcom and other semiconductor companies may also push further into optical integration. A moat based on manufacturing expertise is real only if the expertise keeps moving forward faster than the competitors do. And 6 is valuation. Coherent has roughly tripled in a year. It was added to the S&P 500 in March 2026, and it now carries a market value in the neighborhood of $65 to $70 billion. We already talked about the earnings multiple, but there is a cleaner way to see how much optimism is priced in, and avoid the messy earnings math entirely. Look at price relative to sales. Coherent is currently valued at something like 9 times its annual revenue. For most of this company's history, that number sat close to 2. Revenue itself grew about 28%. The multiple the market is willing to pay for that revenue grew far more than that. Put simply, most of the move in this stock has not come from the business getting bigger. It has come from investors deciding this business deserves a fundamentally different valuation than it used to. That may well be correct. The company generally is different than it was 3 years ago. But it does mean the stock is now carrying expectations, not just earnings. And this is the answer to the question we opened with. Why a record quarter was met with a falling stock? The numbers were never in dispute. The price was. You can see that same disagreement in analyst targets after the latest quarter. One firm moved its target to $500, another moved to $280 and stayed neutral. The stock itself is trading between them, which is roughly what you would expect when serious people disagree this much. Those targets change quickly, so the exact figures matter less than the size of the gap. Same company, same quarter, very different assumptions about how much of the future should already be in the price. This is why a great company can still disappoint investors. When expectations are extremely high, the business does not have to become bad for the stock to perform badly. It only has to become less exceptional than the market expected. So what would tell you the bears are starting to win? Watch for orders falling back toward shipments. Watch for data center revenue flattening from one quarter to the next. Watch gross margin roll over. Watch inventory keep rising while sales stop accelerating. And watch for signs that a major customer is shifting more volume to another supplier. If you want to follow Coherent after this video, these are the 6 things I would check every earnings call. Number 1, data center revenue, quarter over quarter. Do not only look at year-over-year growth. That number can stay impressive even after momentum has slowed. If data center revenue is still rising sequentially, the engine is still accelerating. If it flattens after several quarters, pay attention. Number 2, the order book and how much into the future it extends. Coherent has talked about unusually strong demand visibility. The bullish signal is not simply a large backlog. It is customers continuing to place orders further out, while the companies keep shipping at a high rate. The warning sign is a ratio of new orders to shipments, drifting back toward 1, and the order horizon shortening. Number 3, gross margins. This tests whether vertical integration, product mix, utilization, and a 6-inch wafer transition are actually improving the economics. If revenue grows but gross margin falls, the company may be winning volume without keeping enough value. If both grow together, that is much stronger. Number 4, free cash flow and inventory together. This is how you test the capacity bet. The bullish version is inventory growth slowing, while revenue continues to rise and cash flow improves. The bearish version is inventory rising quarter after quarter faster than sales. Number 5, 1.6 terabit and co-packaged optics customer breadth. Do not focus only on whether Coherent announced a product. Watch how many large customers actually qualify it, and whether those customers move into volume production. A broad ramp is much more valuable than one showcase customer. And number 6, customer concentration and China. Is Coherent becoming more dependent on one buyer? Are US restrictions on Chinese optics actually moving toward implementation? Are new Chinese export controls making the upstream supply chain harder? Those are external risks, but they can change the economics of the business very quickly. So after all of that, this is probably the simplest way to see Coherent. Start on the left with the materials, indium phosphide, compound semiconductor, especially optical materials. Move one step to the right, and you get into wafer fabrication, and the device is built on top of those wafers. Then comes the lasers, modulators, detectors, and other optical components. Those components go into transceivers and large optical modules. Those modules connect into switches, optical networks, and increasingly new architectures like optical circuit switching and co-packaged optics. And at the far end are the customers that actually create the demand: AI data centers, telecom networks, industrial systems, and scientific equipment. That is the company. And when you look at it this way, the investment question becomes much clearer. Coherent does not control every layer. It buys some important materials from outside suppliers. It does not own the digital signal processor inside the transceiver. It competes with companies that are extremely good at building finished modules cheaply and at enormous scale. And ultimately, a relatively small number of very large customers still have a lot of purchasing power. But there's also a part of this map where Coherent has unusually deep control: wafer fabrication, laser manufacturing, optical components, packaging, module integration, and decades of process knowledge connecting one layer to the next. That is what makes the company interesting. The advantage is not one magical product. That is why the 6 numbers we ended with matter: data center growth, orders and visibility, gross margin, cash flow and inventory, next generation product breadth, and customer concentration, including what happens with China. And that, to me, is a real Coherent thesis. More compute requires more data. More data requires more light. Coherent has spent more than 50 years building many of the technologies that create and control that light. The next question is whether those technologies become durable economic power, and the next few years should tell us the answer. If you enjoyed this video and want to see more deep dive like this, please subscribe and turn on the little bell icon. If you want to watch new videos in advance, please consider joining the membership. Research team members can also download infographics from my videos. Thank you so much for watching. I will see you in the next one.